In a low interest rate environment, you might not be doing enough for your portfolio. Joining me to talk about that is Craig Russ, portfolio manager at Eaton Vance and co-director of floating rate loans. Good to see you here in New York.
Nice to be here. Thank you.
I think we should actually start with a definition of what a floating rate loan is for investors.
So these are loans that are made to medium to large U.S. corporations. These loans are typically non-investment grade and are funding some sort of M&A event. So think, for example, Warren Buffett buying Heinz Ketchup. That was a non-investment grade loan to Heinz Ketchup. Burger King buying Tim Hortons. So these are loans that help fund M&A transactions. They're floating rate. We earn a credit spread over LIBOR, and LIBOR floats. And they are senior and secured in the capital structure. So they sit at the top of all the collateral and top of all the other creditors and are first priority on that value of that business. So senior secured floating rate loans to U.S. corporations.
So how do they help investors in terms of the low rate environment? What sort of yields are we talking about with these products?
So today, the yields on this asset class are between 4.5% and 5.5%, depending on the product. So very attractive yields in this very low yield environment. And their key benefit is that they are floating rate. So when the Fed does get around to increasing interest rates, these are assets that will be advantaged in that environment, unlike typical bonds, which fall when interest rates go up. So the yields will go up in a rising interest rate, and the value of the loan itself is stable.
What about the risk factor for these loans?
Well, this is a non-investment grade product, so credit risk is the key risk. But we are senior secured in the capital structure, and a lot of that risk is mitigated by being at the top of the capital.
In other words, if something bad happens, you get paid out first.
That's right. And typically the loan represents 30 to 40% of the overall value of the enterprise. So there's a lot of cushion beneath us, protecting us, a lot of collateral cushion protecting that senior secured loan. So defaults do occur. The average default rate's about 2 to 3% a year, but our recoveries are very high, typically 80 cents on the dollar.
And what's the long-term track record in terms of performance for floating rate?
You typically earn your coupon, 4.5%. It's a floating rate coupon, so if you look at the 10-year returns, it's probably something around 5% or so. Defaults, which are included in that total return, are typically 0.5% a year or so. So gross returns 5.5, net returns 5, something in that range. And it's been a very stable asset class for a very long time.
What about implications with economic changes? If there's an economic downturn, typically what happens, or if the economy heats up, how do we see a difference? And obviously, if the Fed is raising rates, you would see those loans increase.
Most economic environments are very good for loans. So a modestly growing economy like the one we're in today is very good backdrop for credit products like floating rate loans. When we're in a recession, when we have negative growth in the economy, that's typically bad for credit products. But because we're senior and secured, again, this asset class does weather kind of the test of time and through various economic cycles. So for example, during the last large recession that we had in 2008, 9, and 10, default rates were at an all-time high, but the actual damage from those defaults was just a small component of your what was otherwise a very positive return. So during that 3-year period of time, you earn 15% of income, 5% a year roughly, and the total NAV destruction from that recession was about 3% in aggregate. So you earned 15, you gave back 3, positive return through a recession.
Yeah, that's right. How much do you see retail investors using these products in their portfolios?
You know, quite a bit. We've been a retail manager for a long time, and in the question of who owns all these loans, retail is only about 10 or 12% of that pie of who owns the loans. There's quite a bit of institutional demand for the asset class. But retail, we've been managing retail money for a long time. It's been very popular with retail investors in the past. It hasn't been as of late, but we do think its time is coming. It's a very attractive return with a good economic backdrop in an environment where it's very hard to find yield.
Craig Russ, that it is. Good to talk to you. Thanks so much.
Thank you for having me.
I'm Rhonda Schaffler for The Street.